Hi, welcome to another episode of 2 Minutes on Tuesday. I'm Sam Miller of Remax Stars Realty. And this week I want to talk about home equity lines of credit, also known as HELOCs. And what I want to do first is there is a misunderstanding by a lot of people that a home equity loan and a home equity line of credit are exactly the same thing. And there are some differences between the two. And I won't go into a lot of detail, but I will give you a fundamental difference. When you get an equity loan on your house, in a lot of cases, it's a second mortgage because you already have a first mortgage. The bank sends someone out to appraise the house and they determine how much equity you have. And then the bank is willing to loan you a certain percentage of that equity, meaning they'll use your house as collateral to give you this equity loan. It's dependent in most cases on what the house appraises at. But for this example, we'll say there's enough equity to grant you a $50,000 equity loan. Now, when you close on that equity loan, you've borrowed the $50,000, which means when you get your first payment, it's based on a balance of $50,000 because they gave you that loan and gave you the $50,000. And you have the ability to spend that money as you choose. Most people would use it to either pay off other consumer debt, consolidate loans, make home improvements to the house where they don't have to do it out of cash, out of their pocket. They can use the house as collateral to put a new roof on it, new window siding, do updates, room additions, garages, things like that. Where this is different than the home equity line of credit or the HELOC is, let's say you're approved for the same $50,000 and you go to the bank and you sign your closing documents, so your loan is now closed. But let's say you don't need the money right away. So you didn't draw any money against it. The bank still has the $50,000. So you're not really making a monthly payment because you haven't borrowed any monies against it. Now, let's say the same circumstance, you need a roof put on your house and that roof's going to cost $15,000. So you use your equity line of credit and you write a check based on that account for $15,000. And now you've borrowed $15,000 on that home equity line of credit. So when your first payment comes due, it's going to be based on a balance of $15,000. Again, very different than if you got the line of credit where when you did the loan, you borrowed the full $50,000 all at once. So the home equity line of credit can be a benefit. You have a safety net if you need that extra money for an emergency, but in your case, you just needed a roof, so you got approved for the maximum amount they would give you, but you only used the 15, so your monthly payment's a lot more affordable. With that said, most of these home equity lines of credit, these HELOC loans, are variable rate loans. And so the thing to think about right now is that the interest rates have gone up some from the low point in our history where we saw them in the high 2%, low 3%. A lot of these home equity lines of credit interest rate are now in the 7.5%, 8% or even higher range. And again, some of these are variable rate. In fact, the majority are going to be variable rate loans. So you want to watch that because if the interest rates keep ratcheting up, then your monthly payment is going to keep ratcheting up because it is a variable rate loan. So I just thought this was important for you to know, number one, the difference between a home equity loan and a home equity line of credit. But the other thing is if your monthly payment on your home equity line of credit is going up, you want to keep an eye on that because as the rates go up or down, your payment can adjust. So I'm Sam Miller, Remax Stars Realty. If you have questions, give us a call, 740-397-7800. Have a good one. Until next week, bye.